Hi, Greg Dorsey here at Leeb.com, Leeb.com. It's Thursday, August 4th. We'll talk about a buyer's strike. Stocks dropped more than 500 Dow points, with the downside volume on the NYSE swamping upside volume by an astounding 90-to-1 margin. The big question on everyone's mind is if we're witnessing a repeat of 2008 or just 2010. From where we sit, 2010 seems to be much more likely given the modest decline we've seen so far in commodities. On Monday, we suggested watching bonds for an indication of when the Federal Reserve would intervene with a fresh round of quantitative easing. Well, with the 10-year Treasury having fallen to 2.46%, it's safe to say the Fed could act as soon as tomorrow, depending on the market's reaction to the jobs report. If we see a sizable jump in the unemployment rate and probably, and more importantly, just as importantly, a big drop in non-farm payrolls, stocks will decline further and bonds will continue to rally, and that'll force the Fed's hand. From a technical perspective, the next important support level, and it's thin support at that, on the S&P 500 is around 1170. We closed around 1200 this afternoon. Now 1170 would take us back to the November 10 lows, and a decline to that level would roughly match the 2010 pullback that prompted QE2. Now, regardless from what level QE3 happens, be it where we close tomorrow, today or 3 to 5% lower, stocks and commodities are likely to take off once the money printing presses start to roll again. So we would hesitate from running to the sidelines entirely at this point. It could actually be close to a very good buying opportunity. That's all for now. Thanks for stopping by, and we'll have more for you in the coming days.